How many times have you heard that if you had invested $100 in 1950 in S&P 500, you would have millions by now? Or if you just put $500 every month in an index fund, you will be a millionaire in 30 years. You probably have heard the famous quote by Warren Buffett himself saying that most people would be safer to invest in a low-cost broad ETF.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it'd amount to, and it would come to $51 million now.
I mean, after all, he's the most successful investor of all time. So there is no doubt that this is true, and it's fairly easy to verify this as well. You can just visit any compound calculator or investment calculator, put the money you would like to invest every month, the average expected returns, the initial investment capital if you have, and how many years you would invest for, and voila, you can see your thousands in investment turn into millions in just 30-40 years. Congratulations, you are a millionaire, and so you're probably gonna spend it on healthcare. But what nobody tells you, and something that has always bothered me, is that if it's that simple and straightforward, how can people sell? Especially when they are in drawdown or there are financial turmoils, since the long-term expectations is for the markets always to bounce back. It is easy and simple because all those financial experts mention how to start and what to expect as a result at the end of the investment journey, and no one talks about what happens in between this large period. So I backtested this DCA strategy to see the various fluctuations in different economic turmoils and time periods. In today's video we will do things a little bit different. We will explain what is an ETF, what is a DCA, and most importantly we will examine what nobody explains, and that is what happens realistically in our invested capital during that long period of investing year by year. The ups and downs any investor have to endure before enjoying the sweet gains that everyone in the financial world promises. Since the channel is about backtesting your strategies, this is exactly what we will do. Also, stay until the end where I will tell you if and how I'm investing currently and how I use my investment since I'm also trading. Before we begin, just a reminder that nothing in this video or channel is considered financial advice. I'm just showing you my financial journey, what financial experiments I'm personally conducting, and my personal view on those things. If you enjoy these kind of videos, consider subscribe to my channel and hit the notification button so you will know when my next video is up. First, let's explain what an ETF is. An ETF, or exchange traded fund, is a type of pooled investment security that operated much like mutual funds. Typically, ETF will track a particular index sector, commodity, or other assets, but unlike mutual funds, ETFs can be purchased or sold on the stock exchange the same way that a regular stock can. An ETF can be structured to track anything from the price of an individual commodity to a large and diverse collection of securities. ETFs can even be structured to track specific investment strategies. The simplest way to describe it is that an ETF is a basket of stocks or securities that trades on an exchange, contains different percentages of its holdings, offer low expense ratio, and fewer commissions than buying the stocks individually. For example, the most famous ETF, and also the first one, was SPDR S&P 500 ETF with the ticker symbol SPY, which tracks the S&P 500 index, which includes 500 of the best companies in the US. So if you invest $1 in this ETF, you have invested in 500 companies, well, 503 to be exact, and depending in which ETF you have invested, you can check its holdings and how big of a holding each company is within that ETF. For example, in SPDR, the top holdings are Microsoft with 7.15%, Apple with 7.14%, Amazon with 3.44%, etc. So, if you invest in a diversified ETF like this one, you're basically limiting the risk since it's unlikely for all 503 companies to drastically drop in value on the same time. The same applies to the upside as well, since if one or two companies from the ETF explode in value, it wouldn't make a huge difference in the price of the ETF since the holdings of those companies would be quite small. This is one example, and you can use any online tool like Just ETF that I used here to find an ETF that suits you, or research an ETF you heard from a friend or in a YouTube video and see its holdings and the sectors it tracks. Once you decided in which ETF you want to invest in, you need to decide how you will invest. And here comes the DCA. DCA, or dollar cost average, is an investing strategy which, in my opinion, is the closest anyone can find to truly passive income. It makes it easier to deal with uncertain markets by making purchase automatic. It supports an investor's effort to invest regularly, and most importantly, the investor doesn't have to put any other effort like trying to time the markets, etc. Since most certainly all inexperienced investors will get wrecked trying to do it. In effect, this strategy eliminates the effort required to attempt to time the market to buy at the best prices. In other words, you have decided the amount you want to invest in a product, and you invest that amount on specific time regularly without even checking the price. For example, I have chosen an ETF which I believe it will perform well the next decades, and I have automated the investing process without even care where the price of the ETF is now. What that means is, if the price of the ETF in the first month is $20 and I invest $100, I purchased 5 pieces of that ETF. And let's say the second month it went $25, then with $100 I would have purchased 4. Now I have 9 pieces of that ETF, and the average price is about $22. And this is how dollar cost average works. Of course, the same applies on the opposite way. Now that we have seen what is an ETF and what is DCA, let's see realistically, by backtesting the historical data of an ETF, how much your investment will fluctuate year after year besides the total returns of the investment. The strategy I have chosen for this example is very simple. We will invest every month on the S&P 500, SPDR, that we have already mentioned, a fixed amount of money, let's say $200, and then the backtesting period will be for 23 years, from 2000 until 2023. I chose this period for 2 reasons. First, it is more relative to people my age, and more realistic period that someone could have actually invested compared to the start of 1950s or 1928 that the S&P 500 started. And secondly, it is also a period with a good number of financial turmoils. We had the dot-com bubble in 2000, the financial crisis of 2008, and of course the most recently pandemic in 2019. So it is a good example to examine the ups and downs of our investments. There are many ways to backtest, from a simple compound calculator to manually download the historical data and use a spreadsheet, which I also have done. But for my research, I found a more efficient way to do it, and this is how we will do it today, by using a backtesting tool which you can find in Kervo's website. Well, Kervo is an app that manages investments, but we will not go deeper in that video, but it also has a very detailed backtest tool which we're gonna use today. Once you are in Kervo's page, you scroll down, and on the bottom you will find the backtest tool. Once the backtest tool is loaded, it will show you a variety of options to backtest. In our case, we will choose the S&P 500 UCIT ETF, and it will show you instantly the total performance of S&P 500 since 1992 up to date. Now we will click the settings on the top right, and on the simulation period we will choose 2000 January up to 2023 November that it has. You can choose the currency you want to see the results. I will choose US dollars. In the next tab we will choose the option recurrent, and we will put $200 every 1 month. This is our DCA strategy. For transactions fees, it really depends on the broker, so I will put a minimum of $1 per transaction. And most of those ETFs are low-cost ETFs, and usually they have management fees around 0.07%, and I will put this. And on the last option, I will leave yes, this Terra account, which technically means that it will take in considerations the transaction fees and the management fees. Once you scroll down, you have all the stats of your investment for the total period of 23 years. As you can see, the total invested amount is $57,400, and the net asset value is $217,074. That's an average of 5.77% annual growth and a total of 279.4% growth. We have almost tripled the money in 23 years. That's excellent. Now, if you scroll a little more, you will see the actual annual returns, which besides the best year, it also mentions the worst years, where you would face a 35.9 drawdown in the financial crisis of 2008. But still, because the information is so concentrated, and it is a fact that 17 out of 22 years were profitable, it's still unclear how big of fluctuations you would have faced during this period. So analyze it year by year. So in the first year of investment from January to December 2000, you would have invested $2,400, and you would end up with $2,235. That's a negative 688%. The next year you would have 4,800 of invested, and you will end up with 4,304 with a drawdown of 10%. The third year, the total invested amount would be 7,200, and you are now down 23.4%, or $5,515. You understand now that you have started investing, and for 3 years in a row you are in negatives. And besides that, you still need to keep putting 200 every month, seeing your account dropping in value and still putting every month $200. On the 4 years, things turn a little bit around, as the total invested amount would have been 9,600, and you would end up this year with 9,874, and for the first time in 4 years you would be in positive 2.85%. The next 4 years would be a confidence boost, as for the fifth year your 12,000 invested would have been 13,500 with a 12.5% growth. The sixth year you would have invested 14,400 with returns 16,600 with a 15%. The seventh year you will have invested 16,800 with returns to 21,800 or almost 30%. The eighth year you will have ended up with 19,200 invested with a nice 32.2% of returns, or a total of 25,400. You have been now in the markets 8 full years, and you have experienced the downs and the ups. You can see some good and steady returns, and then comes 2008, which we all know what happens in your investments. You would have invested a total of 21,600, and you would end the year with 17,819. That's a negative 17.5% of what you have invested, but it's an almost 30% drawdown from the peak of the previous year. I bet that it would have affected you. To put insult in injury, not only you should have accepted the drawdown, but you should have kept putting 200 month after month. And I don't know for the youngers out there, but me being almost 40, I remember that that wasn't the case for everyone back in 2008. It was really hard to find those extra $200. Not only find them, let alone put them in something that it kept dropping in value. Anyway, if you would have persisted, the next year the total invested amount would have been 24,000, and the returns would have been 25,400 almost, or 5.8% returns. You're already 10 years into investing now, and this is what you have to show. After 10 years, a merely 6% total returns, after facing drawdown after drawdown, and also a couple of better years. Of course, from that point, it only gets better, and I will present you year after year how it is. On the 15th year, after investing $36,000, the year would have closed with $69,980, or a 94.4% growth. It took you 15 years to almost double your investment, after consistently month after month putting in $200. At this point, it is only natural that it gets easier for you to keep doing the same strategy, year after year, month after month. Even in 2018, where the pandemic hit and you would end up about 3% in negative compared to the previous year, you would have still be up 125% of your total investment. From the psychological point of view, it makes huge difference between this occasion and the one that you faced in the financial crisis of 2008. As we saw, after 23 years, indeed, we almost tripled our investment. The significant returns and the compound effect took place in the last 7 to 8 years really. Note, for this example, the results are not adjusted for inflation over the years, and I didn't consider the dividends of the ETF. In the example we used from the curve of backtest results, you can also find a chart where it adjusts the returns for inflations, and you can see it here. Nevertheless, the purpose of this backtesting is to have a clear picture what to expect through the years to your portfolio, what kind of fluctuations one can expect, and have a better understanding of all those people who sell in drawdowns during harsh economical periods. They probably don't have a choice most of the times, but I also can understand losing hope in such periods and getting scared once you see the money side of your investment dropping significantly. On the other hand, this realistic example should help you if your time horizon is quite long, more than 20 years for example, let's say, because it shows clearly, no matter the fluctuations, the compound effect will come eventually and the returns will justify the patience. I personally use this strategy and I invest in S&P 500 a certain amount every month. In my opinion, it's the only vehicle I have found that is closest to passive income. And trust me, I have looked and experimented a lot. I haven't found any other tool where I can truly automate the process and expect an average of 7 to 8% annually without doing anything at all besides have to believe that the US economy will continue growing, and on the same time having so limited downside. The second reason why I'm investing in S&P 500 is a good way to diversify my portfolio overall. But there is one more reason. Besides the quote in the beginning, Warren Buffett has also mentioned multiple times that most traders and investors, 95% of them to be precise, cannot beat the market. So for me, since I'm also trading, I use my investment returns as a benchmark. I monitor all my trading accounts as well as my investments and see if I actually beat the market or not. For example, this year my investment returns were 12% and my trading returns were 25%. So for 2023, I did beat the market. Of course, I know that beating the market consistently is what they mean, and I understand that. But after all, investing and trading is a personal matter and the statistics applies to your efforts. For example, if you never have invested or traded in your life, it doesn't matter what beats what. It only matters from the moment that you have started, or at least this is how I see it. I hope you liked today's video, and like me, you learned something new, and hopefully you have a clearer view of what realistically can happen during your investing journey. I will leave a link to the curve site down below so you can backtest yourself any investing strategy you may have in mind. If you enjoyed the video, hit the like button, and why not send it to a friend who you think it would help. Thank you very much for watching, and I will see you to the next one.